Hi, I'm Matt Culkin, co-chair of Steptoe's Financial Services Group. Welcome to another edition of Financial Services University. We're pleased to present a series of short, focused conversations with my colleagues from across our various practice groups and offices around the world. Today, we're going to talk about insider trading, investigations, and enforcement matters. I'm joined by my colleague from our white collar group in New York, Mike Miller. Mike, thanks for joining me.
Matt, my pleasure. Looking forward to this.
So let's start sort of right at the beginning. What are the three facts or three pieces that everyone should really know about the lay of the land when it comes to either insider trading investigations or prosecutions?
Yeah. Matt, that's a good question and a good place to start. I think, look, the three key facts that people should be aware of, market participants should be focused on. Number one, largely because we are in the midst of this COVID era environment with all of its permutations, there is a heightened risk of insider trading investigations and prosecutions. That is an absolute certainty, number one. Number two, I think it's important for market participants to understand what insider trading is, where are the lines, there are different pieces of information that sort of flow into the answer to that question, but I think that's an important topic. And I'd say the third thing that is important for people to understand is, what are the defenses? Where is the safe harbor to the extent that somebody finds themselves, unfortunately, in the crosshairs of an insider trading investigation or prosecution?
So let's unpack that a little if we can. So you just said, and I don't disagree for a lot of reasons, that we're living in a time of heightened risk of insider trading investigation. What's driving that specifically?
Yeah, I mean, it's an absolute truth. In the midst of this COVID era, there are all kinds of heightened risks of insider trading investigations and prosecutions. Let's start with the fact that the stock market has been gyrating, just incredible drops, incredible recoveries. The overall market dropped 40% in the spring of 2020 and has essentially come almost all the way back, if not exceeded where it started. Individual stocks move 5, 10, 15% in a day, up or down. That kind of stunning fluidity in the market creates enormous opportunities for people to profit when the stock goes up and to avoid losses when it goes down. In other words, ripe terrain for insider trading. That's number one. Number two, we're in an environment where every publicly traded company is sitting probably on unprecedented amounts of material, non-public information. There is no company in the United States right now, publicly traded company, that doesn't sit around and think to itself, well, what is COVID doing to our business today? And what is COVID going to do to our business in 6 or 12 months? And for every question like that, to the extent that there are answers, there is material non-public information within the company that does have the capacity to change market prices. I'd say a third big driver for the heightened risk of insider trading investigations and prosecutions is the fact that while in the spring of 2020, M&A activity that was either pending or potential M&A activity, it all kind of dried up for a few months. But all objective indicia are that M&A activity is on the uptick right now. And of course, anytime companies are involved in M&A activity, particularly in this environment, there is the potential for market moving information within the corridors of these companies. I'd say the fourth big driver for the heightened risk of insider trading investigations and prosecutions is what the government knows. In the midst of the coronavirus, Matt, the government is making decisions that just inherently move the markets. What's the interest rate going to be? How much money is going to be available in connection with stimulus packages? What is the time frame and the likely success of vaccine and cure research going on at pharmaceutical companies that are being massively underwritten by the federal government right now. All of that information is percolating around the halls of the government, and we know it's market moving. We see it every day when the White House announces its latest thinking on these various issues. And I'd say the fifth big driver, Matt, for why we are in an environment of heightened risk of insider trading is that the SEC has made it clear, as they did in the spring of 2020, that they're watching the markets for almost all the reasons that we've just talked about. And the second reason is that there have been decisions handed down by federal courts that have made it easier, and in some instances a lot easier, for prosecutors to go after people who the prosecutors believe have engaged in insider trading. So Matt, in short strokes, all of those are drivers pointing in the direction of a heightened risk of insider trading investigations and prosecutions.
That's great, thank you. And what's interesting about what you just ran through, we've talked about it through the lens of the financial services industry, but really that applies across the board.
Oh, it absolutely does. It applies to companies in every pocket of the U.S. economy, whether it's manufacturing, energy, food products, certainly the financial markets. There is no company that has been untouched by COVID in ways that, with lots of repercussions in lots of different ways, but certainly in the sense that there is a heightened risk of insider trading.
And Mike, you mentioned a minute ago that prosecutors are taking a more aggressive front on a lot of these cases. Let's pivot maybe to talk about how that's presenting itself. Can you walk us through some of the theories of insider trading that people should be aware of?
Yeah, absolutely. So look, let's start with the kind of the threshold fact is that there is no one statute that defines insider trading. There is a statute that speaks about insider trading in the context of tender offers. That's it. Pretty much everything else is based on decisions of judges in the federal courts who are interpreting fairly broadly framed federal securities fraud statutes. And that's where the insider trading law comes from. And those cases point to three theories of insider trading that every market participant should be aware of. Classical or traditional insider trading, the misappropriation theory of insider trading, and tipper-tippy liability. And if I can, Matt, let me just take a minute with each of those three. So with classical insider trading or traditional insider trading, you're basically talking about your classical insider, your CEO, your CFO, or frankly, any corporate officer or employee with a relationship of trust and confidence, with a fiduciary obligation to the company. Anybody who falls into that bucket within a company is in a unique situation. If they come into possession of material non-public information about the company, they cannot trade on that information as long as it is not disclosed to the public. To do otherwise is viewed as being a breach of the fiduciary obligation that those insiders owe to the shareholders of their own companies. So it's pretty straightforward. The classical traditional theory of insider trading is pretty straightforward when it comes to the traditional insider. The courts have expanded the scope of that in an important way to include temporary insiders. So Matt, people like lawyers, auditors, consultants, investment bankers, outsiders, not insiders, outsiders who have no fiduciary obligation to the shareholders of the company, in the broadest of terms, but they're brought in to work on specific projects that do create a relationship of trust and confidence. And those temporary insiders are viewed as being covered by the classical theory of insider trading. They're bound by the same rules as the CEO is. If they get material non-public information, they have to abstain from trading on it or make sure it's disclosed first. So that's the first theory. The second theory of insider trading is the misappropriation theory. And in a nutshell, Matt, the misappropriation theory basically says, look, if you have a relationship, a fiduciary relationship with the source of information, and you breach your fiduciary obligations by essentially stealing that information from the source of the information, and then you trade on it, that is the misappropriation theory of insider trading. And we've seen that analyzed in a lot of different settings. A couple of quick examples. Journalists who know that the articles that they are writing will move the markets. If you're a journalist and you trade on that information before it is published, you are taking from the source, your publication, material non-public information and trading on it. That's a classic example of the misappropriation theory of insider trading. Let's say you work at a printing shop and you're printing material that's going to be used in connection with an M&A transaction. That would be another example where you're essentially stealing that information from the source in breach of your fiduciary obligations. That is the misappropriation theory of insider trading. The third theory that the courts have developed deals with tipper-tippee liability. So think of a tipper as a corporate insider or as a misappropriation defendant who then shares that information with a third party. Now, the third party, the tippee, has no fiduciary relationship with the company whose stock is being traded or with the source. Typically, it's a friend, it's a colleague, it's somebody who the tipper knows. So what creates tippee liability? The courts have said that a tippee can be criminally prosecuted, can essentially step into the shoes of the tipper if the tipper breached a fiduciary duty to the source or to the company's shareholders in disclosing the information and received a personal benefit in exchange for disclosing the information. So you take that, plus the tippee has to know about the breach and has to know that the tipper received a personal benefit. You put all of those together, the tippee now has potential criminal liability exposure for insider trading. So Matt, in a nutshell, those are the three theories of insider trading that federal courts have developed over the years based principally on their interpretation of broad federal securities fraud statutes.
Mike, thanks for that. That's a great sort of baseline inventory for everyone. I want to take what you've just explained to all of us and now talk about its application, because I understand there have been recent developments that make it easier for the prosecutors to go after market participants for insider trading. Can you explain some of that to us?
Sure. Matt, I'd say that market participants should be aware of two developments in case law that relates to insider trading. And they both pertain to that personal benefit issue that I was talking about a few minutes ago. For a tippee to be liable, the tipper has to, breach a fiduciary duty by disclosing the information under circumstances where they're getting a personal benefit. So what's the personal benefit? The first bucket of information that market participants should be aware of is that there have been a series of cases that have relaxed to some extent the duty of or the obligation of prosecutors to prove that personal benefit. There was great case law about 7 years ago in the Newman case here in the Second Circuit. There have been a series of cases since then that have stepped back a little bit from where the Newman case drew the line in terms of what that personal benefit needs to consist of. That's number one. Number two, in late 2019, the Second Circuit came down with a decision that eliminated the personal benefit element if prosecutors use a particular statute to prosecute insider trading. So Matt, most of the cases that I was referring to when I described the three buckets of insider trading were interpreting federal securities fraud statutes. There is also a new statute, basically a criminal fraud statute that applies to securities that was rolled out during Sarbanes-Oxley. I think it was roughly in 2002. That statute is in a completely different set of the federal codes. And that statute, prosecutors have started to use that criminal fraud statute to prosecute insider trading. And the big decision that came out at the end of 2019 was that the circuit said, we are not going to graft onto that criminal fraud statute an obligation to prove that a tipper received a personal benefit. May not sound like a lot, Matt, but for prosecutors who are now using that criminal fraud statute to prosecute insider trading, they're able to step around what can oftentimes be a thorny factual issue, which is whether the tipper received a personal benefit and whether the tippee knew about it. If you use that statute, you basically avoid that thorny issue as a prosecutor. So those are two buckets that I think market participants should be aware of as they think about recent developments in insider trading law.
And so just to make sure I got that last point, what you're saying is prosecutors can now bring a criminal charge, admittedly at a higher standard of proof, but they have to check less boxes.
Yeah, I mean, I think you put it very well, Matt. I think if they use the criminal fraud statute that came out of Sarbanes-Oxley as opposed to the traditional securities fraud statutes, if they use that statute, they don't have to prove that personal benefit element that the courts have interpreted have to be proved in the context of the securities fraud statutes. It's a big advantage to prosecutors.
That's really interesting. Let's now dig into maybe some of the lessons you've learned in your practice. Can you walk us through some of the potential defenses that individuals might want to use if they get caught up in insider trading investigations or prosecutions?
Yeah, absolutely. Yeah, I mean, and first of all, it's a great question. The place to start any discussion about potential defenses in the context of insider trading is to look at what the Supreme Court said about 4 decades ago in the Chiarella case. The U.S. Supreme Court pointed out that Section 10B of the 1934 Act is designed to be a catch-all fraud statute. And this is the language of the Supreme Court. This is key language. The Supreme Court said, but what it catches has to be fraud. So there can be conduct that appears to fall within the 4 corners of Section 10B that is not actually fraudulent. And so that's key language. And then the Supreme Court in the same decision continued to say that the mere possession of material non-public information is not in and of itself criminal. So those are 2 good kind of places to start any discussion about defenses. So when you think about insider trading, when we think about insider trading, the first questions that we're always asking ourselves is, was the information at issue in the case material? Is it information that investors really would have wanted to know in deciding whether or not to buy or sell the securities of a company? Was the information non-public? Maybe it was material, but was it non-public? Now, of course, the classic way of getting information out is through a press release that goes out through, official channels, and then it gets broadly disseminated. But there are other ways that information gets out into the marketplace. And if it's out there and if it's broadly known and knowable, is the information non-public for purposes of insider trading? It's kind of technical legal stuff, but ultimately it's very factual. Was there a fiduciary relationship between the individual trading on the information, and the company where the information came from, or the source of the information? So there's a really interesting kind of factual legal analysis that goes into all of these cases about whether there was truly a fiduciary relationship between the company or the source on the one hand and the individual trading on the other. Let's talk a little bit about tipper-tippee liability, because that's where a lot of the attention is these days in the courts. So if you're looking at tipper liability, one of the things that we're asking right out of the box is, did the tipper reveal the information for an improper purpose? There are occasions where information is revealed accidentally, like a CEO talking on his cell phone and who's overheard by somebody, or the information can be revealed mistakenly. For example, you could have a corporate officer who is talking with a market analyst and thinks that he or she is talking to the analyst about information that's already out there in the public market, but it's not. And so you've got, in the first example, an accidental disclosure of material non-public information. And in the second, you've got a mistaken disclosure of material non-public information. And both of those raise interesting questions about whether there's any criminal liability. And of course, one of the other things that we all are looking at, and market participants should be aware of, is whether there is some personal benefit flowing to the tipper in connection with revealing the information. And so, folks in this business look at whether there's, whether the information is shared as a gift, whether there is some plan to share in the profits of the tippies trading, whether there's some quid pro quo, whether there's something about the sharing of that information that inures a benefit to the tipper, that would bring the tipping, the act of tipping within the four corners of securities fraud statutes. Um, then there's the intense factual question about whether there was some corporate purpose for revealing the information that was at issue. There have been some really interesting cases that have focused on situations where the information, the tipper, shares the information as a whistleblower, or because the tipper believes that the market needs to know about something outside the context of a whistleblowing environment where there is a proper corporate purpose as opposed to a personal benefit at issue. And then, of course, if you're thinking about things from the tippie's perspective, Matt, it really boils down to knowledge. The tippie who trades on information, did that tippie know that the tipper breached a fiduciary duty by sharing that information? Did the tippie know that the tipper received a personal benefit by virtue of disclosing that information? And did the tippie act willfully? Did the tippie act knowing that his or her conduct was violating the law? Those are all the kinds of questions, Matt, that people focus on when they think about whether conduct involving trading on material non-public information morphs into a crime.
Mike, thanks for doing that. That was a great baseline. I appreciate you walking us through everything we've covered today. I hope we can do it again.
Thank you very much, Matt. My pleasure.
So that does it for another episode of Steptoe's Financial Services University, where we explored today the world of insider trading, investigations, and prosecution. Of course, please, you can watch more of our videos and learn more about our financial services practice at steptoe.com. Thanks for watching. We'll see you next time.